Canadians looking to renegotiate a mortgage amid the COVID-19 outbreak will, of course, have some pros and cons of varies versus fixed rates. Economic uncertainty is certainly with us. Marcus Tzaferis is the CEO of Connect. Thanks for being with us, Marcus. And, you know, I don't envy anybody who's trying to make a financial decision in the middle of all of this. So let's start with if somebody is in that position, how difficult will it be, just from the point of view of, you know, your bank is likely occupied, maybe even hard to get through. How serious will that be right now?
Well, I can tell you from what we've seen a huge increase in mortgage applications. And the underwriters that are working on the bank side and the mortgage finance company side have been diligently working, all weekend. So I'm quite confident that their kind of work at home models and the technology that they have in place to handle the influx of applications is working fine for Canadians that are looking to renegotiate right now.
And in terms of the calculation around fixed versus variable, anything different today than it would be for the advice that you would offer normally?
Yeah, that's the kind of question of the week, and it's somewhat ever changing. For the most part, I would say Canadians want to look for variable rate mortgages right now. Last week, we saw variable rate mortgages as low as prime minus 1.1% in some cases. That is an evolving situation as we see banks and now mortgage finance companies increase the premium associated with those variable rate mortgages. So we're seeing some variable rate mortgages now reach prime plus 50 basis points, which is a little worrisome. We'd love to see these variable rate mortgages stay at, below prime. Right now, we see some at prime minus 25 basis points for uninsured mortgages and prime minus up to 85 or 90 basis points for insured mortgages. But the difference we're seeing there is in the ability of these banks to shore up liquidity. It's easier for them to sell the insured mortgages into the Canadian Mortgage Bond Program than the uninsured mortgages. Although we did recently hear from the head of CMHC that they are now buying that the Bank of Canada is buying the uninsured product as well.
We saw last week that even, of course, as rates are dramatically lowered, some mortgage rates did tick higher. Just explain for viewers what the kind of market dynamics are that make that happen. And if that, for people that are in the middle of trying to figure out fixed versus variable, does that change the equation?
Yeah, so, it's unfortunate, but the banks are also dealing with their own crisis right now. They're worried about defaults. They're worried about consumers not being able to pay. And as a result, we may be seeing them gobble up a little bit of that stimulus that the Bank of Canada is pushing into the marketplace. So when we saw the Bank of Canada reduce the overnight rate by 1% and that transfer over to the prime rate, we didn't see all of that come into the mortgage market because we saw a premium priced into variable rate mortgages and fixed rate mortgages. I hope that with the increased liquidity being offered by the Bank of Canada, that we will see those variable rate and fixed rate mortgages come back to a more normalized level. We've got bond yields, Government of Canada bond yields at 60 basis points, and we've got 5-year fixed rate mortgages trading at close to 3%. That just doesn't make sense. There's far too much profit in that line right now.
Well, to your point, the banks have to concern themselves with their financial stability and the pool of risk. We are going to see this period where mortgage payments are deferred and where risk becomes a little bit up in the air in terms of how you measure it if you're a financial institution. Is that going to have some effect on pricing as we go forward, a kind of a detrimental effect for those who are seeking a mortgage down the road?
I hope that we've seen the worst of the increase over bond yields, and I hope that the uninsured mortgage purchases that the Bank of Canada plans on doing will add that necessary liquidity and stability into the mortgage market. Yeah. Listen, I hope that Canadians have access to the monetary stimulus that's being offered by the Bank of Canada. And if you want to count on variable rate mortgages becoming lower because of the Bank of Canada's purchase of uninsured bonds, mortgage bonds, then great. If you don't, it's a good time to at least lock in a variable rate mortgage today at prime minus 20 basis points and hold on to it.
Yeah.
I mean, keep in mind, you can hold a rate on a mortgage contract for 90 to 120 days. So we're seeing a lot of well-informed borrowers calling in and saying, listen, I know that prime minus 1 might not be available anymore. And prime minus 20 or 25 might not be available next week. So hold in a rate, keep that rate, and then you have a few more options in making a decision a month down the road or longer.
That is good advice. Marcus, appreciate your time today. That is Marcus Tzaferis, CEO of Connect.